Hi everyone, welcome to Fifth Person video training series. My name is Victor, co-founder of the Fifth Person. Dividend investing is one of the best investment approach to build an income portfolio that's going to fund you through your retirement. The challenge is to pick the right dividend stock. When you are able to pick the right dividend stock, not only you get to enjoy increasing dividend every year, you also get to enjoy decent capital gain as well. Today we're going to talk about what you should be looking out for when it comes to picking dividend stocks, and hopefully after this video you are able to shortlist good dividend stocks to build your portfolio. So if you are ready, let's go. Now I'm going to show you the 5 steps to pick the best dividend stock. Step number 1, choose mid to large cap stock. In different markets, there's different range in terms of how they define market capitalization size. For the US market, mid-cap stocks are ranged from US 2 billion to 10 billion. Whereas from Asia stocks, the mid-cap stock range from 500 million US to 2 billion US. Whereas for large-cap stock, US define them as more than 10 billion, while Asia is more than 2 billion. So why do we choose mid to large-cap stocks for dividends? Firstly, you need to understand the company life cycle. You can understand them in terms of these 3 categories: stability, growth, and resources. When we talk about stability, is how stable is the company's revenue, net profit, and cash flow. And when we talk about growth, is how fast are they growing their business. And lastly, resource. Do they need more resource or cash in order to grow their business? This part, in terms of the resource, is the part that determines the dividend that will be paying to the shareholder. So at different stages of the company life cycle, the stability, growth, and resources are different. So I will not be focusing on the first stage, which is startup, as it is for new business. So we'll start off with the growth stage, which is the second stage. The second stage, growth, right, is usually for small cap companies which size are usually less than 2 billion USD in the US or less than 500 million in the Asia market. So in this stage, right, companies usually are not stable as they are building their own niche and trying to capture more market share. So they are also in the growing stage. We can see them growing very, very fast, and they require a lot of resources and cash to grow and expand their business. Because they need a lot of resources, right, there's less money to pay dividend back to shareholder. And secondly, is what we call the expansion stage and the maturity stage. This stage, right, is where you can find your mid-cap and your large-cap stocks. They are usually well-established companies that have built up their market share and their position inside the industry. And they usually have stable revenue, net profit, and cash flow. And in terms of growth, right, they tend to be slower in this stage, especially for those that at the stage 4, which is maturity stage. Because they are usually large cap and they don't grow that much anymore because they're taken up most of the market share. And because the growth has slowed down, right, this company no longer require to expand aggressively using their resource. That's why they got more money to return it back to shareholder as dividend. So step number 2 is we want to look for companies with track record of paying dividends. So investing is a game of probability. If the company have a track record of paying consistent dividend in the past, then in the future, right, it will have high probability that you'll do the same. Whereas if the company have a track record of paying inconsistent dividend, then the probability is very high that in the future they'll continue to be inconsistent in terms of the dividend payout. So there's no point if the company is large, successful, has profit to distribute as dividend, but they choose to pay out inconsistently. So when you're looking at dividend paying trends, right, the company that you want to look at should have a long and stable track record of paying either growing or consistent dividend to shareholder. So do remember to check if the company is paying consistently growing dividend over the last 5 to 10 years. So you want to see the track record. So it must be at least 5 to 10 years. Because this shows that the company will grow more and more successful as the time goes, and the management is willing to share the fruits of labor with the shareholder. Step number 3 is we want to look for companies that have fundamentals that are sustainable. So most dividend investor tends to focus primarily on the dividend that they should receive or the dividend yield of the company. while they actually ignore the company fundamental, which is very, very important factors when it comes to investing in dividend stocks. So you need to understand first the overall health of the company. So the fundamentals that determine the health of the company is their revenue, net profit, cash flow, and economic mode. So if you think about it, a company that have deteriorating fundamental means that their revenue, net profit, cash flow, economic mode are decreasing or fading. So there's a very high probability that they are unable to sustain their dividend payout over a long term. Think about it. With less revenue, it comes with less profit, equals to less dividend to shareholder. And when the company start to reduce their dividends, right, the share price will usually tend to fall in tandem with the dividend decrease. So that's the reason why I always like to say it's not about the dividend yield that you are receiving, but rather the sustainability of the dividend, which reflects by the company's fundamental. No point getting high dividend yield and later you lose out on the capital which eat up into your dividend gain. So make sure that when you looking at the dividend stocks, right, focus on finding those who are fundamentally strong and will remain robust for the next few years. Step number 4 is we look for low capital expenditure. So as a dividend investor, right, you want to look at companies with low capital expenditure. In short, we call it CapEx. So CapEx are funds used by a company to acquire, upgrade, or maintain the physical asset in order to maintain the business operation. So let me explain further. So CapEx come in two forms. The first form is what we call maintenance CapEx. The other one is what we call development CapEx. So let me use an analogy to explain to you. So let me talk about F&B company, restaurant. So if you go to a restaurant, right, every time when the restaurant, let's say they got one store number 1, and store number 1 require to refurbish because the store is already wear and tear already, and they start to spend a bit of money to refurbish the store. And that money that they spend is what we call maintenance capex, because when they spend that money, right, it don't bring in extra revenue to the company. Whereas development capex is when the company took the money and open another store, and you bring future revenue to it. So mid and large cap companies, right, they usually have more maintenance capex than development capex, because they usually expand to quite big already and there's not much growth already, so they spend most of their money doing maintenance and the excess money is returned back to shareholder. Whereas for smaller companies, right, they are in the growing stage, so they spend a lot on development capex and also maintenance capex to maintain their competitive advantage. So to summarize it, right, a company with high capex means that they have to continually invest in profits in maintaining their business operation, which means that it's lesser dividends to the shareholder. So for example, the airline industry have very high capex and they need to continually maintain their aircraft, upgrade them to newer models, and after certain amount of years, right, they have to keep doing it over and over again. So while a company with low capex, right, they have more rooms to contribute more dividends to the shareholder because they have lesser capex, right, and there's more dividends. So remember to look for companies that are able to maintain or grow their business with minimum capex. And lastly, we will look for companies with stable free cash flow. So free cash flow is the cash left after deducting the capex from the cash flow. So with free cash flow, right, the company can have options to use the excess cash to either grow the business, do share buyback, or dividend paying back to shareholder. So a company can be profitable on the income statement, but if they have inconsistent in their cash flow or negative free cash flow, it will have trouble paying the dividends to shareholder. So for smaller companies, right, they tend to focus a lot on growing their business, spending a lot on development capex. That's why if you look at smaller companies, right, they tend to have negative free cash flow because they are still expanding the business. Whereas for large companies, stable and they dominate their industry, right, they usually produce very high amount of free cash flow because they no longer required to grow, they just need to spend it on maintenance capex. So the excess free cash flow can be paid back as dividend back to the shareholder. So right now, let me show you how can you apply this 5 steps using a company. So today I'm going to use this company called SATS as an example. It's Singapore Airport Terminal Service. So what business are they in is that they actually provide in-flight catering for airplane and also baggage handling in the Singapore Changi Airport. And they own about 80% market share in the Singapore Changi Airport. So let's look at step number 1. If you look at them in terms of step number 1, they are actually a large cap stocks, which is about Sing dollar 5.7 billion. And if you look at their track record, they have been consistently paying their dividend and consistently increasing from 2011 to 2019. So it's a good sign. And if you look at their fundamentals, whether they are sustainable, their revenues has been hovering around very flat. They are maintaining their revenues. Their net profit has been consistently increasing. So it's a good sign. And if you look at their cash flow, it's also consistently increasing. And next is we want to look at step number 4, which is low capex. So if you look at their capex to their cash flow, right, their capex is to their cash flow is slightly less than 30%, which is quite good. If you look at airline business, right, their capex to cash flow usually is about 80 or maybe 100%. So that's not so good because they are very high in capex. So right now, let's look at step number 5, the free cash flow for SATS. So if you look at SATS, their free cash flow is rather stable. Most of the time, they are above their average line, which is the black line. There's only 3 times in their 10 years that they are below. So they are rather stable. You can see that from 2013 to 2019, actually is rather stable. And let's look at their share price performance when they have fulfilled all these 5 criteria. You can see that with the increasing dividend, with the strong fundamental, the low capex, and the steady free cash flow, their share price also performed for the last 10 years. And see, dividend stock is quite different from growth stock. The idea of a good dividend stock is the ability to pay consistent and increasing dividend. When you can pick the right dividend stock, you should see your dividend increasing every year. Now I have a bonus for you. We have compiled a list of dividend stocks that have been consistently increasing their dividend. You can find the download link in the description box below. And finally, if you like this video, do remember to hit the like button below, share with your friend, be sure to subscribe. Thanks for watching and I'll see you in the next video.